Everyone has a certain number in mind when it comes to their overall retirement. Is it 500,000? Is it a million? Is it 10 million? Do you know what your number is or how much capital that you need to accumulate for you to have a comfortable retirement? Stick around, you will figure it out today on another wonderful episode of Your Money, Your Wealth. Welcome everyone. Happy to be here. Joe Anderson, certified financial planner, president of Peer Financial Advisor, with my partner, of course, Big Al Clopine. He's sitting right over there. But when you're looking at an overall retirement strategy, I think we try to picture what number savings that we have to accumulate, right? But that's just the start. When you're looking at a true organized financial plan or a retirement strategy, the number is just one thing. Have you looked at your income? Have you looked at taxes? Have you looked at your investments? The number is a moving target. That's today's financial focus. Hey, there's a lot of rules of thumb when you start thinking about a retirement strategy. Here's probably the biggest one that we see as advisors, is that you will spend 80% of what you're currently living off. So, for an example here, let's say if you're spending $50,000 currently, that once you reach retirement, you'll spend $40,000. I have not seen this for most people that have saved money. People do this that don't necessarily have a strategy in place. Because think about it, when you're retired, it's Saturday every day, or Saturday or Sunday every single day. And so what are you gonna do today if it's Saturday or Sunday, right? You're probably gonna find time to spend money, right? When we're working, we don't have the luxury to go out and do different things, to travel, to go to restaurants, and all the things that we love to do. So make sure that you don't use rules of thumb. Here's another interesting statistic, 1.7 million. Charles Schwab did a study, and they're like, how much money do you think you'll need to retire? 1.7 came out. Where the heck did this number come from? Right? I don't know. People have nowhere near 1.7, but it sounds pretty good. No, don't use rules of thumb. Get a plan specifically for you. To help us with all of this, let's bring in the big man, Alan Clopine.
Yeah, Joe, I agree with you. Where the heck did the 1.7 million come from? And are you on track for that number? Is that the right number for you? Not necessarily. We're going to explain how to think about this. It's creating a financial plan, a dynamic financial plan, which means it's changing as your life changes. So how do you go about that? Starting with setting your retirement date. What is that? Age 62, 65, age 35, whatever it may be for you. And then consider what your retirement lifestyle, what you'd like it to be, and have some fun with this. Is it traveling? Is it golf? What is it for you? Then figure out an investment strategy that's going to fuel this retirement goal. And then consider your taxes, because if you can save taxes, you can stretch those dollars further. And then finally, create a withdrawal strategy, a distribution strategy, so that you're not going to run out of money. And Joe, these four things seem simple, but there's a lot to them.
Yeah, there's subcategories with each.
Yeah,
right. Because first of all, you pick a retirement date, but that could change as you get closer to that retirement date. Right. Because once you have a strategy, it's like, I want to retire at 65, but then you reach 65, you're still healthy, you enjoy your job, you might want to continue to work to age 70. We see that quite often.
We do, and the other thing, Joe, is how long are you going to be retired, and no one really knows how long they're going to live. But let's consider some statistics. Like right now for a 65-year age couple, there's a 50% chance that at least one of you or more, at least one of you is going to live to age 92. So that's a long time, right? 75% chance one of you will make it to 87, and 25% chance to 96. So Joe, I think the key is you have to plan for a longer retirement than maybe our parents and grandparents did.
Yeah, and as we get closer and closer, 10 years from now, 20 years from now, where do you think technology is in regards to health?
Supposedly we're supposed to live to 120, right?
Yeah,
Is what we hear.
Bryson DeChambeau, he's a golfer, he wants to live to 140.
140.
Yeah, there you go. Not me. I'm done. 85, I'm
85-ish?
good.
Yeah, okay.
Yeah, right? But let's look at this real quickly. Real simple steps to make sure that you can have a very good retirement is that Al already talked about it. Picking a retirement date, you got to start somewhere, right? If I want to travel, you have to have a destination. So this is just a good starting point. I want to retire at 65, 70, 62, whatever your number is, start there. Then you can see if you're on track or not. You also have to consider your longevity. But then here, what is the lifestyle? Because now you're using leverage here that you can toggle, right? Hey, maybe I want to spend $150,000 a year. Maybe it's $30,000 a year, okay? And then you got to check the math and then adjust, right? So let's kind of run a quick example, Big Al. Let's to see, to help people do this at home.
Yeah, and I think 1 through 3 is fun, but then you got to check and see how close you are. So we'll go through this example. So let's say you're 62 and you want to retire in, say, 3 years. So that's age 65. Okay, so we have a date there. Longevity, let's say you feel like you're kind of in average health, so we're going to go to that 50 percentile, so that's age 92. Then you got to look at your spending. Now this will take a little bit of work, right? But in our example, Joe, $75,000 is the spending, but $40,000 is needed from investments.
Yeah, and what you will need to do there is just take a look, in a guesstimate of what you're currently spending, but then you look at your fixed income. And why we say, hey, I want to spend 75, but I only need 40, is because this person has Social Security. Maybe you have a pension. Maybe you have real estate income. Maybe you have other ancillary incomes that are coming in from other sources. So just take an inventory of A, what type of assets and capital that you have, and then second, what type of income that you can expect, not including the capital. So if you have income coming in from pensions, real estate, Social Security, whatever, look at all of that, and then you can kind of start doing some math here to see if you're on track.
Yeah, and then you really want to compare how you're doing. So take a look at your savings right now and do a little projection. Where's it going to be in this example 3 years from now? And let's say you come up with $500,000. So I want to spend 40 and I got 500,000. So we do a little math. We divide 40 into 500, we get 8%. We want this to be 4% or less, so 8% just simply doesn't work. So Joe, then you kind of have to go to work and maybe adjust 1 or 3 here.
Right. So you could, A, smoke a lot of cigarettes, right? And so you could...
True, that's one way to go.
So your retirement age, right? So I want to retire at 65. Well, you know what? Maybe you have to retire at 67, 68, okay? And then 75,000, maybe that's a little bit rich. Can you reduce that? Right? $500,000 is what my nest egg is. Hey, is there a way that I'm going to work 3 more years so I can save 3 more years of savings, right? And increase that, let that continue to grow. Your Social Security is going to be a little bit larger because you push that out. So it's just basically starting with this, right? To see if it's feasible. And then the second step is just kind of shaking things up to see how the math is going to connect.
Yeah, and I think, Joe, a lot of people, they really don't look at this, and then they retire, and then they're shocked, right? And in many cases, all you need to do is make a few little changes, and this can work out a lot better. A lot of people are working part-time in retirement just to create a little income to push their Social Security out. In many cases, Joe, that's a great way to go.
Are you ready for retirement? Go to yourmoneyyourwealth.com and get our retirement readiness guide, right? Click on the special offer this week. Go to yourmoneyyourwealth.com, click on the retirement readiness guide, and you can walk through your own financial plan to see if you're on track. We got to take a short break. We got Peter Keller. He's a certified financial planner, senior advisor at Peer Financial Advisors, joining us after the break. You don't want to miss that. We'll be back in a second. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Alan Clopine hanging out here talking about retirement planning. Stick around this segment. We got Peter Keller joining us. He's a senior financial advisor and a certified financial planner at Peer Financial Advisors. But before we get to Pete, let's see how you did on that true-false question.
Under the Secure Act, I can now contribute to an IRA at any age as long as I or my spouse have earned income. And that's a true statement. That wasn't always true before the Secure Act because you only could do it up to age 70 and a half. Now, anyone, any age can do an IRA without regard to their age.
And speaking of retirement plans, you have to figure out how do you invest it too.
Yeah, you do. I mean, so we talked about how to figure out, what your lifestyle is going to be when you're going to retire, consider your longevity. Now let's create an investment plan to be able to get there. Probably the first most important thing is that you automate your savings. I don't care whether it's a 401k or auto withdrawals from your checking account or money coming from your pay directly to your savings account. If you automate it, out of sight, out of mind, it'll happen. So Joe, that's number one. That's probably the most important thing on the whole list here.
Yeah, for those of you that are still working, of course, you want to make sure that you pay yourself first. But then when you start constructing your investment portfolio, the second biggest decision is, well, how much risk do you want to take, right? So that question is, how much money do I want in stocks versus bonds? That's one of the most crucial decisions that you all want to make in your portfolio. And that needs to be based on your specific situation. Then you can get fancy, right, and look at what types of investments do I want to get into? Do I want to get into individual securities or mutual funds or ETFs? Or then what types of investments do I want to get in smaller companies, larger companies, international companies, and so on? And this is really defined out by your risk.
It is, and I think some people like to invest in individual securities. We don't have a problem with that. We would prefer to have you invest in mutual funds or index funds or ETFs just because they're more diversified, and a lot of them have very low fees. And then in some cases, like with gold and real estate, you can actually own the asset outright, and that has some advantages as well. But I think for most people, if you focus on the mutual funds, index funds, ETFs, you probably have the best investment experience.
Hey, you know what? Enough of me here, Al. Let's bring in Pete Keller. I'm interested to see what his take is in regards to efficiencies from a tax perspective on how to construct the overall retirement plan.
Thanks, Joe. And Pete, thanks so much for joining us.
Hey, it's good to be back with you guys.
So we all have heard about investment diversification, making sure you have a little bit of different kinds of investments. But what is tax diversification, and why is it important to consider in retirement planning?
Yeah, great questions, Al. And let me take it in two stages for you. So let's talk about tax diversification in creating your investment strategy. You've got three pools that you can essentially put your investments into. And each one of these pools is going to get taxed differently. So you've got the tax-free pool, the taxable, tax-deferred. Tax-free, that's going to be your Roth IRA or Roth 401k. Taxable, that's any account held outside of a retirement plan, any kind of a capital asset outside of retirement. Then tax deferred, this is going to be your 401k, your IRA, TSP, kind of your traditional retirement plans. Now, when money goes into a Roth account, it's going in after tax. Once it's in the account, it's going to grow tax-free, and when you withdraw from the account, it comes out tax-free. So no better rate than tax-free. Over here in the taxable account, this is when you put your after-tax dollars in. That starts your basis. And let's assume, maybe a $50,000 investment. And then as it appreciates in value to $100,000 and you sell it, coming out of this taxable account, you get preferential tax treatment, capital gains rates. So that's going to be at, depending on your income, can be as low as 0, 15%, 20% for high income earners. And then out of this account, this is where in your 401k, your IRAs, TSP, money has gone in on a pre-tax basis. So when it comes out of here, you're going to be paying the highest tax rates. So this is going to be taxed as ordinary income when the money comes out. So the reason you want to have tax diversification is so that you can create a tax-efficient retirement income. You want to have the ability to pull from all three pools to create your retirement income. So like Joe said earlier in the show, if you have pension, Social Security, you'll want to pull from this account only what you have to get up to the top of the tax bracket, and then maybe pull from tax-free and taxable so that your standard of living might be up in the 24 or 32% tax bracket, but the most you've paid in tax is 22.
Yeah, so Pete, I think when we talk to people, they have most of their savings in tax deferred, which of course is the highest tax rate. So how do they get more money in the tax free?
Great question. So in building up your various accounts, you've got a couple of options with getting money into the tax-free, because this is really the golden goose that's going to allow you to control your taxation on your retirement income. And so you've got a couple of options. First, if your 401k plan allows Roth contributions in it, you can make direct deposits through your 401k plan. Outside of that, you've got two other ways. One is you can do Roth contributions, where you're taking after-tax dollars and you're making a contribution to the Roth, and you have to have earned income for that. So that's $6,000 plus another $1,000 if you're over 50 that you could put into the tax-free account, and you can do that as a spouse as long as there's enough earned income. The second method would be to take dollars out of the tax-deferred and convert those dollars into the Roth account. Now, when you do the conversion, that's going to be taxed as ordinary income, so you want to be mindful of where you're at within your tax brackets.
Yeah, so if people can have money in each of those pools, if they will, then they can control their taxes in retirement a little bit better. And then when it comes to the taxable account, there are ways to reduce taxes there, such as tax loss harvesting. So let's go over what that is.
Yeah, great strategy. So here's the deal with tax loss harvesting. Now, a lot of times people will want to just sit on their hands and ride out market fluctuation. Well, that's not the best use of your money. When you're creating retirement income, you want to do it tax efficiently, so there are strategies you can use with tax loss harvesting. So let's say you've got a stock that has gone up in value and you're kind of late to the game and you purchase it at a peak. From there, it falls. Well, you can sell from your peak to the trough and put that loss on your tax return, so that when you're creating retirement income and you have to sell something else on down the road at a gain, you can offset that gain with the loss that you've harvested along the way. So you don't want to sit on your portfolio, you want to be very proactive with your portfolio. There's opportunities in bulls and there's opportunities in bears.
Yeah, and of course when it goes down, when you sell, you create that tax loss, and then you want to buy something similar so you receive the recovery. Great strategy, Pete. Thanks so much for joining us.
Thanks so much for having me, Al.
Hey, that's great insight, guys. I want to thank Peter Keller for joining us. Wonderful job, Pete. But to help you all out, why don't you go to yourmoneyyourwealth.com and click on that special offer this week. It's our retirement readiness guide. Are you ready for retirement? Are you prepared? Do you have a tax strategy, investment strategy? Do you have your goals lined up? Go to yourmoneyyourwealth.com right now. Click on that special offer. Absolutely free of charge. It's our gift to you, our loyal watchers on Sunday morning. Yourmoneyyourwealth.com. We got to take another break, and when we get back, we'll wrap it up. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Alan Clopine hanging out here talking about how ready are you for retirement? Do you know your number? Do you have a tax efficient strategy? How about your investment philosophy? All of the above. Don't forget to go to yourmoneyyourwealth.com. Click on that special offer that we're giving all of you today. It's that retirement readiness guide. Go to yourmoneyyourwealth.com. You can click on it right there on the website. Before we wrap up the show, let's see how you did on the true-false question.
Buying a rental property would generally give you a large tax deduction to minimize income taxes from your salary or other income. And I'm going to say that's false. There are cases where you can get a tax deduction, and one of which is if your income is below $100,000, you can write off up to $25,000 of losses. But a lot of folks, Joe, that we see, they have a lot of income, they're trying to buy real estate for sheltering, but the passive loss rules prevent the deduction.
Yeah, I would say, Alan, that most people said true on that question.
I would think.
Right, but because we get it all the time. It's like, well, here, I'm making a lot of money. I want a tax shelter, so let's buy a bunch of real estate to shelter the taxes. But as Alan said, if you have a higher adjusted gross income, doesn't it phase out, Big Al? $100,000 to $150,000, then that $25,000 deduction will phase out. So if you're making more than $150,000, you have zero benefit whatsoever. So just understand the passive tax loss rules is key to devise any type of strategy. And then when you go into retirement, then you have to look at, all right, well, I've accumulated some assets. Maybe you do have real estate, Social Security, pensions. Then it's figuring out, well, what is the appropriate distribution rate? What's feasible?
And I think that's a mystery to a lot of people. And there's different ways to do this. And really, probably the best is ongoing monitoring and seeing how you're doing. But just as some quick ideas to give you some thoughts, there's three different strategies. One would be the 4% rule. The 4% rule just simply means whatever I have in terms of liquid assets, I can take 4% of that. I've got $1 million, I can take $40,000. So that's, and hopefully your portfolio is earning more than that. So next year your balance is higher, you're taking a little bit more. Another one would be called dynamic withdrawals. And you could sort of use that same 4% rule, but you just take more when the market's going up and less when the market's going down. So you kind of adjust those withdrawals. And then finally, some people like to just take their required minimum distribution, which used to be at age 70 and a half. Now it's age 72. That distribution amount as a percentage keeps going up each year, so that can be a way to go. But Joe, I think a better way to go really is to come up with a plan, a dynamic financial plan, and then monitor and manage it as you go.
Yeah, without question. I mean, I think these are good rules of thumb. I mean, if you can follow some of these guidelines, you're going to be far better off than most people, because they're just playing a guessing game in regards to how much money that they need, right? And then how much money that they can take out. What does that portfolio look like? They have no clue in regards to tax planning or tax savings. But if you start coordinating some of these things together, you'll see how your assets will tend to grow a little bit better. That has nothing to do with the overall investments, just because you're a little bit more strategic. Hey, Al, let's switch gears. Let's go to Ask the Experts.
I don't need the money from my required minimum distributions to live on. Can I convert my required minimum distributions to a Roth IRA? This is Rich in Scripps Ranch. Joe, we get that question a lot, and unfortunately you cannot.
Yeah, when you think of a required distribution, right, it's a mandate by law that you have to take money out of your retirement account, right? And the reason why they want you to do that is for you to pay taxes. And it's like, all right, well, here, the government is telling me to take $10,000 out, $20,000, $40,000 out. I have to pay the tax anyway, and maybe I have a pension, Social Security, or other income sources where I don't necessarily need to use the full distribution or any of it. Well, why can't I just put that into a Roth IRA? I paid the tax, now let's grow it in the Roth. It would be great if we could do that, but unfortunately a distribution is just that. It is a distribution out of the retirement account that needs to be out of any type of retirement account. So a Roth conversion, for instance, would be classified as a rollover, if you will.
Yeah, I mean, one thing you could consider is you don't have to take a required minimum distribution this year, 2020. So you actually could, in essence, do it this year, but not normal.
Yeah, explain that a little bit more, because I think with the tax legislation, that the CARES Act that came out, and the Secure Act moved the RMD to 72. And so people get confused there. But now the CARES Act, it was like, well, there is no RMD. So let's say your required distribution was $10,000, right? You don't have to take the $10,000. But let's just say you're in those lower tax brackets. It still might make sense to take the 10 grand and then convert it into a Roth.
Yeah, exactly. So even though you don't have to take your required minimum distribution this year, you might want to take it in kind of another way, right? Which Rich, it's kind of your question. You could take what would have been your RMD and convert that to a Roth IRA. 1 year and 1 year only, Joe. It's not, but not normally. You can't do that.
Let's go to the next question.
I'm 67, employed, and planning on maxing out my 2020 IRA contribution. Can I make a $7,000 2020 IRA contribution for my 77-year-old unemployed husband, too? I checked with both my financial advisor and CPA, and there's a disagreement on his eligibility. So, Joe, what do you say on that one?
I don't know. That's a really long question. I wasn't even paying attention. No, we answered this earlier, right?
We did.
So there's no age limit anymore. So, yeah, your unemployed husband, 77 years old, you should get to work. No, right? He's retired, but you're still working. It's a spousal contribution. So it doesn't matter how old he is, he can still make a spousal contribution up to the $7,000. You can still make your contribution to the $7,000. There is no age limit whatsoever, as long as one person of a married couple has earned income up to the $14,000.
Yeah, and that is the key, and that's brand new. And like we said in the earlier segment, it's strange that a Roth contribution you could make at any age, IRA you couldn't make after your required minimum distribution age, but now that has changed with the CARES Act.
Well, let's see. What did we learn today, folks? first and foremost, right, we want to make sure that you set a date and a lifestyle. Well, we have to have an end date for any of the numbers to make sense. And then you're looking at, all right, well, how do I achieve these retirement goals? What type of plans do I need to put together in regards to my investments? And then you have to take a look at the tax implications of your overall investment strategy that's creating the income. And if you have a tax efficient withdrawal program, guess what? Right, you're on the path to retirement. Congratulations. If you need more help with this, you know where to go. Go to yourmoneyyourwealth.com. Click on our special offer this week. It's that retirement readiness guide. Yourmoneyyourwealth.com. Click on special offer. It's our retirement readiness guide. So thank you so much for joining us, Big Al. Great job today. And that's it for us. We will see you again next week with a lot of great information on retirement, taxes, probably Roth stuff, investments, who knows. It's going to be fantastic. We'll see you next week.
All right, we've got to keep talking. Yeah. Episode 6.
Oh, this is all the disclaimers.
Yeah, right. Well, yeah, so we're kind of
So we need
we're
about
in a little,
15 more minutes
We're
in
in a
this
little box, while they kind of keep moving.